Good evening, everyone, and thank you for taking your time to join me today. My name is Sara, and I have spent over a decade in the financial markets as a proprietary trader and as a financial mentor with a primary focus on currencies, commodities, and stock indices. I hold double master's degrees in economics and finance. Apart from that, I'm licensed from FINRA USA as a commodities and currencies trader. I'm also an accredited investment manager in line with ESCA UAE regulatory requirements. So, over the years, I've worked very closely with traders, brokers, and investors to help them understand how to decode the markets using a very holistic and sound approaches. I've been involved in financial journalism, such as investigating financial fraud cases, and I have been giving professional trading courses to investors for over 10 years. Welcome to Amana. I am sure many of you are familiar with it. Amana is a non-traditional brokerage which has multiple regulations, which are both local and international. Some of these are DFSA and ESCA UE regulations. Apart from that, we have regulations from Europe, Lebanon, Mauritius, and Malaysia. So all of these regulations ensure the safety and security of your funds. We have a specialized focus on MENA region, which means that we offer you, different a wide variety of instruments, which are regional as well as international. You can have access from the same platform to over 5,500 financial instruments across multiple asset classes, which include regional and international stocks, forex, commodities, as well as digital assets. And again, these instruments are both leveraged and non-leveraged. So you have the option of trading them either as cash instruments or on leverage. Before I begin this very interesting presentation, um, I want to tell you that there is a Q&A section below, and if you have any questions, please post them and I will try to answer them as we proceed. So I think that most of you know what is the topic of this presentation. If even if you're a beginner or if you are already trading, this session is going to be very important for you because in this session we are not going to be talking about strategies. We're not going to be talking about indicators or how to predict the market. We are actually going to be talking about a very, very important thing, which helps you survive in the market, which helps you preserve your capital before you can actually even think about making profits. And that is the risk and the leverage mechanics, which you need to understand very clearly. The thing to understand is that most traders lose money not because they don't know how to trade, not because they don't know how to predict the markets. They might be very good at that, but it's because they don't know how much they're risking and what they are risking. And that's exactly what we are going to fix today. This webinar is divided into two parts. First, we're going to discuss the basic concepts of what is margin and leverage and why are they important and why were they actually introduced. In the second part, we are going to discuss how you can use this leverage to your advantage while at the same time protecting your capital and maximizing your gains. Let us start off with what leverage is. So leverage is basically a multiplier, okay? Leverage is simply a multiplier and it allows you to be able to control a large position size for a very small amount of capital that you have in your account. For example, if you have a leverage of 1 to 100, so leverage is expressed as a ratio. As you can see on your screen, a leverage of 1 to 100 would mean that for every $1 that you have, you can trade $100 in the market. So this represents a leverage factor of 100x. So the margin, on the other hand, is the collateral which you have to put up with the broker in order to obtain this leverage from the broker. So this leverage is actually borrowed funds which are available to you from the broker. So the broker makes these funds available to you and gives you this capacity to be able to trade much higher volumes from what you have in your account. As an example, if you have a $10,000 account and if you have a leverage of 100, so you can just multiply the amount that you have in your account by 100 is 1 million. So what that means is that if you were to use your maximum possible leverage, which is actually not quite possible, but theoretically speaking, from a $10,000 account, you would be able to open positions worth up to or close to 1 million, although that would be extremely risky. But then it's again, I'm trying to give you an idea of how powerful leverage can be and how it can increase the prospects for you as a trader. And these prospects are both prospects for profit and prospects for loss. So again, if leverage is your power, then margin is the cost or the price of accessing that power. So let's move on. So again, margin and leverage are both related concepts. They cannot be separated. Leverage is again simply a multiplier, and margin is the amount of money that has to be locked in your trading account in order to access that leverage or open a certain position. If we see a leverage of 1 to 100, that is equivalent to a margin of 1%. In other words, if you have to get a trading exposure or open a position worth $100, you need to put up $1 or as margin with the trader in order to open up this position. Again, if the margin declines to 0.5%, what that means is your leverage has increased to open a position or gain market exposure worth $200. So again, they are inversely related with each other. The higher the leverage, the lower the margin required, and the lower the leverage, the higher the margin required. Now, let me explain to you, and this is something I'm sure that a lot of you, this question must have risen in the minds of many traders, that why does leverage even exist? Why was leverage even introduced in the first place? Why not just trade on cash and just trade with what you have in your accounts? So the first and the foremost reason why leverage was introduced is to make trading possible without huge amounts of capital. So originally, markets like currencies and commodities involved very large contract sizes. For example, in the foreign exchange market, you must be knowing that the standard trade size is $100,000 worth of any currency. And that was the contract size that usually the institutions are dealing with. So it's 100,000 euros, 100,000 pounds, or whatever. Now, most smaller participants cannot afford this full value. So the solution was leverage. You deposit a small amount of capital, and from that small amount of capital, you can, instead of paying the $100,000 from your deposit, a small margin would be locked to access this position or this much bigger position. So again, leverage was introduced. People could participate without the need of putting up massive amounts of capital. The second most important reason was to improve liquidity in the markets. So markets obviously would be more efficient, would be more liquid. The more activity there is, the more the number of participants, the more the buyers and sellers. So without leverage, only big institutions could trade. But with leverage, more participants would be able to enter the market. So more participants mean more trades happening, means spreads become tighter, means volatility reduces, means price gaps reduce. So markets become more efficient. And you would have a buyer for a seller and a seller for a buyer at most times. So the important reason was the leverage would increase participation, and the participation increases liquidity in the markets. Another important reason why leverage is here, why it's being used so much, is to support price hedging or price risk. So leverage is used by oil companies or airlines or exporters to hedge against a price rise or a price fall, to hedge against price risk. So what happens is, for example, an airline which is buying fuel and they are afraid the fuel cost would rise, and they just don't want to lock they don't want to pay millions up front. They will just want some kind of protection against a price rise. So leverage allows them to lock in the price when they take up a position of equal quantity on the platform without tying up any additional capital. So even if in the physical market, the price of fuel goes up, that is going to be offset by any profits that they make through hedging. Leverage allows businesses to manage risk without locking up huge amounts of money. Another reason, like we've discussed, is to increase capital efficiency. So instead of putting up all money in one trade, traders can actually use a small margin to open one trade, and they have rest of the capital free to invest or diversify in other assets. Again, we have discussed most of these reasons why it's important to have leverage. And again, if you have free capital, you can diversify, you can be more flexible, you can practice better risk management. One important reason why leverage is here is to enable short-term trading. Now, and that this reason is more relevant for retail traders like us. So without leverage, what happens is that smaller price movements will remain small. For example, the currencies like the euro dollar, daily movement is quite small. So let's say it's 0.25% or 0.5%. Even if you are to catch that daily movement in your favor, let's assume, even if you are to catch that full daily movement of 0.5%, let's say, on a $10,000 account, that is $50, which is not very exciting, which might not be considered like a very good return for many people. Leverage actually allows you to increase your returns for the movements, because it is allowing you with small capital to trade big amounts. So when you're trading big amounts, your exposure is huge, and the profit from that small movement is much bigger. Leverage basically turns small market movements into tradable opportunities. So initially, leverage was created for hedgers. It was created for professional traders, for institutions. It was actually not created for the way that we use it, or the way you see most people using it. It was not really created for speculative trading, but we see nowadays that it's being used by traders because they do not fully understand its implications. And they say that leverage is a double-edged sword. It was initially designed to improve the markets, but it was not actually designed to increase risk. But misusing is actually creating a lot of risk. So retail traders have access to this same tool, but they do not understand it deeply. And that's where the problem lies, because leverage is not dangerous by itself. Misuse of leverage is what actually destroys accounts. And that is the most important mindset shift that you need to make. Leverage is not a way to make more money. Leverage is just a tool that you can use to trade more efficiently. And if you understand that, then you are going to be ahead than most traders. So again, most people think that okay, if my account has I have heard some people say this is too much. There's this leverage too much. I want to reduce my leverage. But actually, what you need to understand is that this leverage is not what is directly affecting your risk. Your risk is determined by your position size. It is determined by the quantity that you use to trade. And the quantity that you will use to trade is something that you are entirely independent to set. And this is free of leverage. So, how much I wish to trade in a market is something that I am going to decide as a trader. Okay. And that is then what is going to determine how much leverage I have used on that particular position. And that is going to determine my risk. It's going to determine my profit or loss. So having more leverage or having, even slightly less leverage is not doesn't impact your trading. What impacts your trading is your risk management strategy. And your trading is impacted by, how well you are executing your risk management, how you're sizing your position rather than your leverage. So I just want to show you the trading platform, and here we are on the Amana app. So I think most of you are familiar with this by now. And if you want to know the leverage factor, you can just select a particular instrument or you can search for that instrument up here. So for example, if you want to see how much leverage is on gold, just click this and then scroll down and you will see here that the leverage is specified for this particular instrument. If you want to change the leverage for any reason, you can just click here on change. And so by default, the leverage is fixed as the first column. But if you want to increase your leverage, then you can just send this notification to the team, and then they will be in touch with you. They will approve the leverage or however. So similarly, if I look for WTI, which is West Texas Intermediate, the leverage is 50 to 1. So there is, again, you can change this from this option here. So yes, so you can also see the maximum leverage. So for gold on the Amana app, we have a maximum leverage of 200, and for silver it's 200. For majors, again 200. So the maximum on this app is 200. But if you want more leverage, then we have a different dynamic leverage on the MT4 platform. So for MT4, we have dynamic leverage, which means that it increases with the amount that you trade. So for gold, this is the leverage that we are offering. As you increase the lot size, so by the way, one lot is equal to 100 ounces. From 0 to 15 on MT4, we offer a leverage of 1 to 400, and then it will definitely reduce as you increase the lot size. I have a question from Amana Invest. So I will address this question towards the end because right now the topic is not Amana Invest. Amana Invest is basically, a scheme that we offer whereby people can invest in a portfolio of stocks and in order to earn monthly returns. Then we have this dynamic leverage for the majors. Again, the maximum is 1 to 500, and then it reduces as you trade more. And again, for indices, the maximum leverage is 1 to 200, and it is going to reduce as you keep on increasing your position size. And I think the reason for that is that's because the broker is managing the risk. The larger your position size, the more dangerous it becomes for both you and for the broker. So they reduce this leverage automatically. So again, the larger the positions, the higher the margin, the lower the leverage. So we have this system in which a bigger position size will correspond to lower leverage. So now I hope that you're clear about this, and I just want to show you again on the platform how margin and leverage is shown. If you're trading any particular market, for example, let's say gold, and you want to place a trade, you can see that you can enter by the amount or you can enter by the units. So if you enter the amount, which is 100, this represents the margin. So if the leverage is 100, which you can see over here, So 100 times 100 is an exposure of 10,000. So it means that you are actually going in the market with a position of $10,000, which requires you to put a 1% margin with the broker, and that 1% is this $100. So if you just look at this value on top, it says total invested. This value is my total margin right now. This is the amount that has been locked in order to open the position that I have open at the moment. And if I place this trade, so this $100 is going to be added to this margin. So let's say I buy, and you can see that $100 has been added to the margin. So my account value is, which is the equity, which is the floating profit plus my balance is 58,000 right now. The available balance is my margin, sorry, it's the account value minus the margin. So 58 minus 4,900, that's 53,600. So I have still 53,600 left to take more positions. Similarly, if you want to, there's another option of entering the units by entering the quantity by units. So if I click here, and I can just enter 10, and this means 10 ounces. So 10 ounces are equal to, so 1 ounce right now is equal to $4,729. So 10 ounces would be equal to $47,300 right now. And again, if I go by this method, then I will be able to see the margin right here. So the margin is again going to be 1% of my exposure, because I have a 1 to 100 leverage, which means a 1% margin. So my total market exposure, the total value of my position is $47,000. 1% of that is 473. And this is what I need to open this position. So again, when I buy this 473, my margin is going to be added into the total margin, which is displayed right here. So as we see, the margin value now goes up to 5,300. Let's move on to the next important topic, which is regarding so the next topic is something that is very important. It's very close to my heart, and that is risk management. Risk management is a more bigger than strategy or more important than strategy. That is completely 100% true. So you can see quotes in front of you from Warren Buffett, from Stanley Druckenmiller, and from George Soros. And all of them are saying the same thing. And that same thing is your survival comes first. Because if you lose your capital, you're out of the game, and there is no capital, no trades, no future. So in my time as a trader, so I started trading from 2012, and it's almost 14 years. The one most important lesson that I have learned in my trading career is that I cannot stress the significance of risk management enough. And if you were to ask me if I were to put, a percentage on how important risk management would be, then I would say that out of the three, areas of trading, which is the market strategy, risk management, and trading psychology, risk management, I would assign it a value of at least 40%, along with trading psychology, which is another 40%. So trading discipline and trading psychology along with risk management forms 80% of your trading success. And sorry, excuse me. Sorry. Yeah. So trading psychology and risk management are so important that they should form the main focus of your trading. And I see that mostly, when traders are discussing strategies with each other, or when we see, different analysts discussing, it is always about the market. It's about where the market is going, what are going to be the levels, what are the different economic announcements, and this and that. But, I beg to differ. I think that definitely one needs to have a solid strategy which focuses on market prediction. But more important than that is how you manage your risk per trade. And I will go as far as to say that if you have two people and one of them is very good at managing their risk, but does not know anything at all about how to predict the market, while the other one is very learned. They know every strategy, every tool. They use every kind of tool to predict the markets, but their risk management is weak. I can confidently say that the person who cannot predict the markets would probably have, let's say that they are put in a hypothetical situation where both are allowed to trade. The person whose risk management is in place is probably going to have better results than the person whose risk management is weak but who is very good with market prediction. And this is something that should just sink into you, and you should, if you're looking at seriously at trading as a career, you should never forget this. Um, Always place the utmost importance, your most energy on understanding and developing and executing a solid risk management strategy. And you will start to see the results much more quickly than you believe. Now, I want to show you this mathematical reality of recovery, which says that losses can hurt you more than gains can help you. And I think we don't think in these terms, but let's assume that we start with $100 and we lose 10% in our account. So now we are at 90%. To get back to to where you were, to get back to your initial trading capital amount, you need a gain of not 10% but 11, because 10 on 90 is 11%. And similarly, losses compound against you exponentially. So again, assuming I lost, um, you know, 50, I lost 30% of my account. I will have to recover 43% of the remaining amount in order to just reach to the break even, in order to just get back my capital. So it starts to become more and more difficult with time, because this is exponential damage. If you lose half of your account, you have to basically try and double your account, so which is going to take a miracle, which is why risk management is very important, and it's everything, because once your losses compound, you will be just you are basically fighting the math. So then what can be the best way to manage your risk? And this is exactly, what we're going to learn next. So there are two very important and integral things that you need to do to control your risk. The first one is that you need to know what is your dollar risk per trade. And that is something that has to be predefined. And that is something extremely, extremely important. So whenever I go into a trade, I know exactly how much I'm risking on that trade. And I see a lot of people who will say that, okay, I found a good setup and I traded one lot, or I took two lots, or I took five lots. But I know a lot is a standard, but it's really not a standard for your capital, because everybody has different amounts of capital. So, saying let me just trade one mini lot, or let me just trade half a lot, that is that is not proper risk management. What you have to do is you have to fix your risk per trade, and that can be done in two ways. Now, the first way, which is the simple way to understand, is you have to fix it as a percentage. And according to experts and experienced traders, and as well as my experience scores, I think that a level of 1 to 2% per risk is a good level of risk to fix. So, for example, if you have a $10,000 account, you should not be risking more than 2%, which is $200 per trade. And that applies to, you can apply the same principle to other equities as well. So I'm giving you a $10,000 example because it is just simple. But then again, if you have a $50,000, then 2% of that comes out to be $1,000. So you would not be risking more than $1,000 per trade. Okay. Now, I know that some of you might be thinking this is too less, or why this is the case, but this is actually not too less. So if you have to think it, one perspective that I can give you is let us suppose that you have, risked 2% on a trade, and good trades definitely give you risk reward of 2%, 2 times or 3 times. So a 2% risk can yield you a 4% reward if your risk reward is 1 to 2. Risking $1,000 means you are aiming for at least double or 2,000. In terms of the account percentage, that is a 4% return coming just from one trade. Or if your risk reward is 1 to 3, then your percentage return is 6% just from one successful trade. And you know that, what are saving accounts giving you these days for an entire year? That's maximum of 5 to 6%. I know that when we are trading, we look at the screen and we think it's very easy to make money, but actually the reality is different. The reality is that if you do not control your losses, there is no way that you will get any kind of consistent results. And the only one way that you can control your losses is to fix your risk per trade. So before going into any trade, you have to make certain that your risk is fixed, and I will tell you how you can fix this risk. Now, another way of doing this, which is a slightly different way, is that don't fix the risk in terms of percentage, fix it in terms of dollar amount. So let's say I have a $10,000 account and I don't define my risk in percentage. I say that instead of 2%, I will let's say I will risk $250 per trade on this account. So this is another method, and sometimes it can be more effective. And why it can be more effective is because if you are, let's say you have a losing streak, and if you lost some money, if you're $10,000 down to $8,000, right? And if you are using the percentage method on your equity, so your risk per trade is going to reduce. So 2% of 8,000 is what? Yeah, it's 160, right? So you are going to be risking 160 per trade, which can reduce the chances of your recovery. It can slow down your recovery. So if you fix your risk per trade as a dollar amount, even if your equity goes down or if it goes up, you still can, especially if it goes down, you can recover your capital at the same amount. So that is just another way, but then you can keep a rule which says, okay, if my account size increases by 30%, then I will change this dollar amount and I will increase my risk from $250 to $300. But then it has to be a guideline which makes sense, and then it will be a guideline which is meticulously followed by you. If you keep on varying this dollar risk per trade, it's going to really mess up your trading. As I gave you this example, if your equity falls below your balance, if you have a smaller risk per trade, it's going to make it hard for you to recover. And similarly, if you are growing your account, then you also you need to increase your dollar risk per trade by some amount so that you can actually exponentially make exponential gains in your account. So I hope I am being clear, but a more simple way of looking at it is select a risk per trade, which is around 2% of the account's value, and then stick to that value. No matter if you're losing, no matter if you're gaining, just stick to that value. The second important thing, which comes when you have to manage your risk, is the stop loss size. Now, talking about stop losses, I'm sure most of you know that this is an automated order that you place in your trade. And so you place this order, and even if this is going to basically limit your losses. So there's always an option. If I just click here and I have this protection and I just select this, and I can just put, so if If it's a buy trade, then my stop loss price level is going to be below the market price or below where I entered. And if it's a sell trade, then the stop loss price is going to be above where I entered or above whatever is the entry price. Okay. Now, the important thing to understand is that, first of all, there is no, you can't compromise on the stop loss. So, for every single trade, there has to be a stop loss. And again, I know some of you might be trading without stop losses, or you might be thinking differently, or you might be thinking, okay, if I keep on holding on to that trade, there will actually come a time when, the market might reverse. Why should I put a stop loss? Because, I feel the fear that I'll just be stopped out and then the market will resume the course that I predicted earlier. I know, and all these feelings are completely valid. But the fact is that, risk management requires and you to accept that there has to be a stop loss for every trade, and the level of the stop loss is something that is very important. So this is a particular level that uh, makes you feel sure that you were wrong. So I will repeat this, that the stop loss level has to be such where you are completely sure that according to the market structure has been broken, and whatever I predicted is probably wrong, and now I need to get out of this trade, so I am fine to be stopped out. Again, stop loss placement is an art, and it is something that is not at all random. So I know there are the people who have strategies or who where they just have an arbitrary stop loss, like a $50 stop loss or a $20 stop loss, or in commodities, or maybe in oil, you have what, a $3 stop loss or 50 pips in some currency. But actually, the proper stop loss placement depends on the structure of that market, and it depends on the support and resistance, depends on the logical invalidation levels. Logical invalidation levels are again those levels where you are completely sure that your idea or your thesis about the market did not hold true, and therefore now you wish to, instead of hanging on to the losses, you wish to now get rid of the trade instead of increasing your losses. And yes, when the stop losses are hit, it does make you feel uncomfortable, it does make you feel painful. But you're if you're managing your risk per trade, and you know that if I am wrong, this is the amount of loss that I am going to have, which I just spoke about earlier. I spoke about restricting your risk per trade to a certain value. So once you would be anticipating that, this is the maximum amount of loss, it will be easy for you to actually put a stop loss and to adhere to all these risk management principles. So now I'm going to give you some examples of how to put your stop loss. We're going to do some live examples, which are very important. But first, let me tell you, what do you do next? So what you do is you then calculate your position size by taking your dollar risk and dividing that by your stop loss size. So your stop loss size is basically your entry price minus your stop loss price. So if, let's say, in oil, your entry price is $93 per barrel. Your entry is at 93, stop loss is 88, stop loss size is 93 minus 88, it's $5. That's your stop loss size. Your dollar risk was, in my previous example, let's say 250. So 250 divided by 5 is going to give you the number of barrels that you should be trading as part of your risk management. Again, the position size is everything. So I'm going to run through these examples very quickly before I move on to the platform. And I actually do, some calculations over there to make you understand how you can position yourself. Let's suppose you're trading euro dollar. Now, this risk again is fixed and it is going to come from the amount of money that you have in your account. And like I said, it should be around 2%. So let us assume this was a $50,000 account and 2% of that is, $1,000. So on this $50,000 account, my risk is fixed for all the trades, no matter what is the market, what is the structure, what is the volatility, whatever is happening, my risk is fixed. The stop loss size is according to the structure of the market, let's say below a support, below a price action signal, it comes out to be 50. What I'm going to do is I'm going to divide my dollar risk per trade divided by the stop loss size. Please remember, this is not the stop loss price. This is the stop loss size. It's given by the market price minus the stop loss price. So that is 20 pips. So 20. So sorry, that is two standard lots. Similarly, I have given examples for gold and Brent. Again, the risk is fixed. If your stop loss is 20, let's say you're entering at $5,000. $5,000 is the market price. You're entering at, 49.80. Sorry, you're putting a stop loss at 49.80. Then the stop loss size is 20. And doing the maths, it comes out to be 50 ounces. And 50 ounces is what you are exactly going to be trading. And in that case, if your stop loss gets hit, you go home with a loss of exactly $1,000. That is what you anticipated. So you have to work your way backwards to the position size rather than arbitrary, randomly selecting a stop loss or randomly selecting the risk. Again, your position size is something that you will always be able to control. And that's exactly what you need to control. So let me just give you an example here. Let's go to WTI. Okay, this is West Texas, or let's go to Brent. This is Brent oil. Now, it's trading right now at $94 per barrel. Okay, again, the value for this particular account was 50,000. So I will be risking about $1,000 on this trade. So my dollar value is risked. Now, the next thing is I need to know where should be my stop loss. So the stop loss, which is selected according to the market structure, and that is actually, something, if you keep following this webinar series, I will be teaching you how to place stop losses, depending on the structure of the market, how to read the market, how to read price action, what constitutes good entry points, which are the charts that you should be trading. All these topics will be covered in the subsequent webinars. So please also attend them. Here, sorry, I would just like to make the point that you can see, let us suppose that, we have a bias that, so first you need to be clear about the bias. So let us suppose we have the bias that the market will go up. So I need to be buying. So what I will do is I would place my stop loss below a price action signal or a pivot point, which in this case seems to be this. Again, this is an example. It's not a perfect trade. It's just an example. And this is the daily time frame, by the way. So you always use the daily time frame as my reference point for fine-tuning entries. So I'm going to put a line here. So again, this is going to be a valid stop loss placement for this particular trade, which is quite a wide stop loss. It's almost 11 points. But again, this is how, I would place the stop loss if, I was, if you asked me, okay, what could be a valid stop loss here? So one other way that if you want to reduce your stop loss in order to increase your position size could be to put a limit order here. So you could probably put a pending order, a pending market, a buy limit order a bit lower than the market. So let's suppose that, I put a pending order at 89, and then if the market hits 89, it will trigger this particular trade with a stop loss at 83, which would be better because I also want to make, if my stop loss comes out to be too wide according to the market structure, then I will try to squeeze my stop loss using a limit entry. So just to, let's suppose that, our entry is at 89, stop loss is at 83. That's 89 minus 83. That's $6. So then I am going to just calculate how many barrels of oil I should be trading for my risk management, which is going to be 1000, sorry, divided by 6. So this is going to be roughly, so 1000 is my dollar risk per trade, and the 6 is the size of the stop loss, is your entry, which was at 89, minus your stop loss placement, which is at 83. So this is going to be approximately, 166. So we can say 167 barrels. So the answer is going to be it's always going to be in the units. So then I will just place this trade. Sorry, I have to change this to amount to units, and then I can just put 167 here, and then I'm going to buy. So what this will do is it's going to restrict the risk on this trade to exactly $1,000. I have a stop loss of my choice, which is a point where I feel that I will accept that I was wrong if the market has hit my stop loss. And what I do is I tune my size, my quantity to my parameters. And this is how I do my risk management. And it's similar for all markets. I'll give you another example in gold. Let's look at the market price. Let's assume I put my stop loss where the blue line is. So again, the dollar risk remains the same. It remains 1000. The stop loss size is going to be your entry price, which is 4715. As you can see, this red line, minus your stop loss, which I just said is below this particular candle, this price action right here. So 4713.5 minus 4607, it's a $108 stop loss. So it's going to be 1000 divided by 108, which is my stop loss size. And that comes out to be 9.25 ounces. So again, for gold, 108 is going to be stop loss size, and I will do the same. I will go by and I will change the amount to units, and then I will write 9. So I can round this off to 9 or 10 ounces. 9.25, I can just round it off to maybe 10 or 9. So let's say 10. And then I'm going to just hit the buy button. So this ensures that, my risk is very contained and it's exactly the way that I planned. One important thing that I also want to draw your attention to is the fact that, your total exposure. So your total exposure is going to be all of the trades that are opened in your trading account. Now, if you are something like a high frequency trader and you are opening many trades at one time, then you have to be very careful with what is your overall exposure. So let's say in the same example, if I'm risking 2% per trade and I'm a low frequency trader with just 2 trades open versus I'm a high frequency trader with 10 trades open. So the low frequency trader will have a 4% overall exposure, while the high frequency trader will have 10 times to 20% overall exposure. In that case, I think that you also need to take a look at your overall account exposure at every particular point in time. And you need to make a guideline about keeping that to a certain level, such as maybe 10%. So then you could just reduce your risk per trade from 2% to 1% because you are opening many trades at the same time. And another thing which is important to consider is also the correlation between different markets. So let's say I am trading in, S&P, and I'm trading in Dow Jones and Nasdaq and Euro 50. So I'm trading in, or FTSE, I'm trading in all of these. I really like the indices. Now, most of these indices are very highly correlated, which actually means that my risk is more than what it seems to be. So it is like, in a way, the higher the correlation, the more risky it becomes. And then there are a lot of currency pairs which are directly or inversely correlated with each other. So I think that you also have to take care about these correlations because they can actually magnify your risk. So you might be thinking this is just, okay. So you might be thinking that you have some kind of diversification, whereas you don't. And if you are wrong in one, then you are wrong in all of these markets, which exposes you to much greater risk. So, this topic is actually very interesting, and it has other elements to it as well, which I will be discussing in the next webinar, such as the risk reward ratios. But I think that today we have very less time left. So I will just be, reading some questions, and I will try and answer some of the questions that we have. But before everything, I just want to make a point that risk management and trading psychology are completely related and intertwined. Risk management is a tool that really allows you to execute your trading with discipline. So it helps you to gain that emotional control because predefining your risk is acting as a safety net. It's neutralizing a lot of fear. It's eliminating a lot of, emotional spikes which are caused by bigger losses. So again, I always feel that good people who are good risk managers will always be able to manage the trading psychology in a much better way. Again, this kind of strict risk management is going to lead to more consistency. It's going to lead to more trading confidence and more discipline. Now, let me look at some of the questions. I think most of them have been by my colleagues. There is a question about position size, where can I find it? And also the swap rate cannot be found. Okay. Position size is something that you actually enter by yourself. So it's not that you can't find it, but if you might be talking about the contract size. So here we don't have the contract size in Amana app. For example, depending on what you're trading, for example, if you're trading gold in units, if you write one, that is equal to 1 ounce. 1 ounce, not one lot. So if you're doing 10, that's 10 ounces. It's similar for oil. It's similar for S&P. So, if you're entering one, that is going to be one contract of S&P. The swap rate, where can it be found? It can be found if you just select the instrument here and you scroll down. Sorry, yeah, select the instrument from your watch list, and if you scroll down, you will see the overnight fee here. So for every instrument, it is defined here. For example, if you buy, you will have to, pay 0.018% of the total positions value. And if you sell, then you will receive the same amount. You will receive swap of the same amount. And this is, again, these are percentages calculated on the total exposure of the position. So actually, there are some questions, but most of them have been answered, and any questions which are remaining will be answered, by the team. And you wish if you wish to contact us, we have an email. It's support@amana.apps. So if you have any remaining questions, you can send an email, support@amana.app. Okay. And I think it's time to end the webinar, but thank you so much for attending. And I hope that you learned something. And I hope that I will be able to see you in the next week for, our next webinar. So just remember, risk management is not just about protecting your capital. It's about, developing your long-term consistency. It's about reducing your emotional volatility. It's about, enforcing discipline. It's about promoting consistency. It's about creating the foundation of a sustainable trading system. And successful trading is, in reality, less about predicting the markets. It's more about managing yourself. And the best way to manage yourself is to first understand how important risk management is, and then to be able to execute risk management, as a bridge between strategy and psychology. And that is what is going to ultimately define your success as a trader. So thank you so much, and I will see you next week.